quite a few economists who were worried that we were about to enter a recession. The technical definition of a recession is 2 consecutive quarters of negative growth. The less technical recession is I just lost my job and I'm looking for another one. And neither of those is the case right now, fortunately. We saw a pretty good uptick in terms of consumer spending. And when it comes to the GDP, about 2/3 of the GDP is made up of consumer spending. The estimates for the third quarter from the Atlanta Federal Reserve are equally strong. They're coming in at close to a 4% growth rate, which again kind of blows most of these estimates out of the water.
Hey folks, welcome to Expert Insights, the fall housing forecast. We have Rick Sharga joining us today. We're going to give a couple minutes to let folks get settled into the webinar, and once they get all in here, we'll start going through some of the things that are on the agenda. So we'll give it like one more minute, and then we'll get started. If you want, go ahead and go into the chat. You can share with us where you're from, and feel free to chat. We appreciate it. We'd like to know who you are. Give us a shout out. Oh, is my voice echoing? I'm sorry.
It might be something on the other end, Jerry, because you're coming through fine here.
Okay, thanks, Marie. Let me know if it gets better. I will. We'll take a look at our tech here to make sure. But okay, I see Williamsburg, Virginia. That's great. Adams Asset Management in Georgia. Cool. Some folks right here in Florida. West Palm Beach. Welcome. Welcome, Raj from Dallas. That's great. Cool. So while we get some more folks added in from all over the U.S., north, south, east, west, Massachusetts, Minnesota, let me talk a little bit about the agenda today. First, I'm going to talk a little bit about A&D mortgage and our history and what we do here. And A&D mortgage is really happy that we're able to get with Rick and hear some of his insights. So I'll share a little bit about our company, and then Rick's going to talk about the U.S. economy in general, some of the demographic trends, and then investor activity, foreclosure. You can see this all on the screen, of course, and then we'll do some closing thoughts and a Q&A at the end. As you have questions, please post them up as you have them. So one, you don't forget them, and two, we may want to answer them before going forward. And the other thing is Rick will most likely answer a lot of these questions because he knows what you're going to probably ask. But if we don't get to something, at the very end, we're going to have a Q&A session for you so we get you taken care of. So yeah, share your chats and reactions with us, converse as you like. We really appreciate your activity in it. Your video and phones are for participants are muted, so we just are listening to Rick and a little bit of me, and so we'll go to get started here. Let's start the agenda and talk a little bit about A&D mortgage. We've been in the industry for 20 years. Whether you've been around for 20 years or not, we've been doing this quite a long time. We're one of the top non-QM lenders in the United States with over 8,500 partners. And we're not only do we have 20 plus loan programs available, we're always adding new programs that are designed to meet the needs of your borrowers. And so this is something that's a huge priority for us at the company. So, of course, we welcome you to partner with us. And so you can have access to all these great programs that we develop. They're specifically centered on loan originators to help them get the options they need to solve borrower issues and find the lending solutions that best fit. But we operate coast to coast. We have excellent turnaround times. It's something we really pride ourselves on. And we offer a range of programs, including like our AD Vantage loyalty program, which is a fantastic mechanism where you earn points for closing deals, and then you can use those points to help you close more deals, and then you earn more points. It's a fantastic system. So we encourage you to take a look at that. But our story, 20 years of expertise. We have a family of companies. Imperial Fund works in conjunction with us so that we can get the funding needed, especially in the non-QM sphere, so that we have enough lending available, and it really keeps that channel open for you, and so that we have plenty of funding to take care of our partners. And this gives us a plethora of options as well, which helps the whole system function. Our footprint, you'll notice that we said coast to coast. We are just about everywhere in the U.S. There's a couple holes that we're still trying to fill with licensing and whatnot. And you'll notice that some of the states with asterisks at the end, there's no license required for business purpose loans on those, but we operate everywhere you see here. So we're pretty we're pretty thorough on trying to cover the whole U.S. So our guest, if you didn't know who Rick was already, and you probably do, but I'm super excited to introduce him as our speaker today, and that's Rick Sharga. He's a virtual rock star in the housing and mortgage industries. But in case you're not familiar with his background, some of his accolades, and his depth of experience, here's just some of the highlights for you. Rick is the founder and CEO of CJ Patrick Company. It's a market intelligence and advisory firm for companies in the real estate and the mortgage industries. He's a well-regarded expert and one of the country's most frequently quoted sources on the U.S. economy, on real estate, mortgage, and in foreclosure trends. Additionally, you might have seen him. He's been featured as on a host of different leading networks like Bloomberg and CNBC, CBS, NBC, CNN, ABC, and others. He's got over 20 years experience. There's that 20 word again. 20 years experience in real estate and mortgage industries, including roles as the EVP Market Intelligence at Atom Data, EVP for Carrington Mortgage Holdings, and EVP of Marketing at Realty Track. So great depth of experience, and we're really excited that Rick's joining us, and we're happy to call him a friend of AD Mortgage. So with that, I'll turn it over to Rick.
Thank you very much, Jerry, and appreciate the opportunity to be part of this today and hopefully share some information that is useful for everybody who's attending. We are going to talk about the economy. We're going to talk about the housing market, and inside the housing market, some of the drivers, like demographic trends, like what we're seeing in terms of investor activity, and what's going on in the foreclosure market. Spoiler alert, what's going on in the foreclosure market isn't very much right now, but since a lot of investors, a lot of buyers are looking for those kind of properties, we thought it'd be useful to talk about that a bit as well. As Jerry said, fire away those questions into the chat area. We'll try and cover as many of them as we can before we wrap up today. And we're going to go through this in pretty rapid fire order. The folks at A&D have permission to distribute these slides later, so you don't have to take copious notes as we're going through in case you're interested in anything you see on the slides. And I know this is being recorded, so there's a chance you'll be able to get a copy of that afterwards as well. So let's just kind of jump right in, talk about what's going on in the U.S. economy. The GDP, the gross domestic product, is the sort of shorthand that economists use to gauge how well or how poorly the economy is doing. It had a booming second quarter this year. This was the second revision to second quarter numbers. It came in at a growth rate of about 3.8%, which was way higher than most economists had forecast. In fact, we went negative in the first quarter, and there were quite a few economists who were worried that we were about to enter a recession. The technical definition of a recession is two consecutive quarters of negative growth. The less technical recession is I just lost my job and I'm looking for another one. And neither of those is the case right now, fortunately. The first quarter, in fact, was as low as it was because there was an overwhelming amount of imports. We had companies, manufacturers, other retail operations, and others rushing to import goods, products, materials before some of the threatened tariffs took place. And an import is considered a negative on the GDP. So we had a cutback in government spending that was pretty significant, and we had all these imports. And the combination of those two really is what caused the first quarter to be negative. But the second quarter was booming. We saw a pretty good uptick in terms of consumer spending. And when it comes to the GDP, about two-thirds of the GDP is made up of consumer spending. So when you see strong GDP numbers, it typically means we're seeing a fairly healthy amount of consumer spending. The estimates for the third quarter from the Atlanta Federal Reserve are equally strong. They're coming in at close to a 4% growth rate, which again kind of blows most of these estimates out of the water. Most of the economists, if you talk to them, looked at their early year forecasts. We're talking about GDP growth over the course of the year at 1.5%, and we're running at roughly three times that as we go through the third quarter. That green line you're looking at there is the Atlanta Fed's nowcast. It's kind of a real-time estimate of what's going on in the GDP, and it typically is more accurate than what we see from the blue chip consensus, if you will, the range of economic estimates on where things are going. So again, pretty good outlook for the third quarter. We'll see how that goes now that we're in the fourth quarter. Obviously, December is a very, very big month for consumer spending and retail sales. So we'll see how this all hangs together going forward. But at the moment, overall economic numbers look pretty good. The stock markets, something else that people have a tendency to take a look at when they're talking about the economy. We saw the numbers tank this year back in April, when around Liberation Day, when all the tariffs were announced as possibly taking place. The stock market didn't like that very much. But since that has come roaring back. It was down a little bit yesterday, but all three indexes, the Dow, the S&P, and the Nasdaq, are either at or near record highs right now. So they've come back very strongly, and they're responding very well to good earnings that they're seeing from a lot of the bigger corporations on the various indexes. So again, GDP strong, stock market doing very, very well. Job numbers have been one of the red flags in the economic overview. And if I'm looking at one macroeconomic trend to try and gauge how well or how poorly the housing market's going to do, I do tend to look at jobs. So the job numbers, as you know, because it's been in all the press, were revised downward pretty significantly by about 800,000 jobs in recent months. We've seen a changeover in leadership at the Bureau of Labor Statistics, who reports this data. Not a political issue in my mind. The same director who reported on this removal of 800,000 jobs also reported about 900,000 fewer jobs for the previous administration in the last year of the Biden administration. The problem here isn't political affiliation. It's what happens when you're trying to very quickly put out numbers based on huge, huge amounts of data. The Bureau of Labor Statistics is tracking about 160 million jobs. And in doing so, if they're off by 0.5%, that's a miss of about 800,000 jobs. And that's really all we're talking about here. So job numbers are still positive. They're not as strong as we'd like. It is a bit of a red flag, not a lot of hiring going on. The flip side of that is there's almost no firing going on either. Unemployment is still very, very near record lows. We're at 4.2% as of the last report. That's the last report we're going to see for a while because of the government shutdown. But even Chairman Powell from the Federal Reserve mentioned that it's a very unusual labor market. Usually when you see low job creation, you see high layoffs, and the firing numbers are pretty high too. Right now, nobody is hiring, but nobody is firing either. It's almost like the market's in limbo, kind of waiting to see how things shake out in the long run before they start either hiring in large numbers or firing in large numbers. So it's not a strong jobs market, but it's not a terribly weak jobs market either. It's just a very unusual one. While this is going on, wages are continuing to grow. The average hourly payment, the hourly salary, if you will, for somebody in the country right now is around $31 an hour, highest it's ever been. And so wage growth, which has been going up around 4.5% a year, is actually going up at a higher rate than inflation. So for the first time in a number of years, people's wages are growing faster than the rate of inflation. Last report we saw in inflation, which again might be the last one we see for a while, came in at about 2.9%. That's not quite as good as the Federal Reserve's target. They're looking to get down to 2% inflation. And it had ticked up a little bit, I think, from 2.7 and 2.8 to 2.9 in recent months. But it's still, historically speaking, not all that bad. If you look at the last 50 years of inflation data, what you'd find is that the average rate of inflation annually is somewhere between 3.1 and 3.3%. So even at 2.9%, we're doing better than we've done historically. The reason it doesn't feel much better is because we had that huge burst of inflation a few years ago, coming out of COVID when the government injected $15 trillion into the economy. And that caused inflation to go up to 9% a year, which was a real hit on most people's budgets. So things are still going up, just they're going up more slowly. And it takes a while for wage growth to catch up to that, even though we're doing a little better today than we were previously. So GDP going pretty well. Jobs market not strong but not weak. Wage growth happening. Unemployment or inflation not as high as it's been in recent years. So generally speaking, the economy's in a good spot to support a strong housing market, both in terms of owner-occupied properties and in terms of rental units. That said, the big issue continues to be, and the big headwind for the market continues to be affordability. We've never had a period of time before in the history of the country where home prices went up 45, 50%, and then mortgage rates doubled. And yet that's what happened between 2020 and 2022. So in 2020, as we were in the midst of COVID and coming out of COVID, we had a rush of people out buying homes, among other reasons, because mortgage rates were the lowest they've ever been in history. They were down as far as 2.5% in some cases. And that made affordability okay. So it's the last blue-gray area you see on this chart, as those historically low mortgage rates offset home prices that were going up astronomically. When mortgage rates doubled in the second part of 2022, we saw affordability plummet. And right now, this is from the Atlanta Federal Reserve, their affordability index would be at 100. That's the line running across the top of the page. Today, it's at 64, which is a very, very low number. And what we're seeing is really the lowest affordability level since the 1980s. And back then, it was a time, as you know, when interest rates were at 18, 20, 22%. So really difficult time, particularly for first-time buyers, to be able to get into the market. And the way they gauge this is what would your median salary need to be in order to buy a median priced home and spend 30% of your monthly income on housing costs? And today there's a $45,000 annual gap in affordability. The average household income, the median household income across the country today is just below $80,000. The median income you would need to be able to buy that median priced home while spending 30% of your income on housing costs is about $125,000. So that's the affordability gap that we're really looking at. And it varies from market to market. There are some markets, for example, in Ohio and Western Pennsylvania, that are actually very affordable right now. There are markets in states like where I am in California right now, where virtually nothing is affordable. But it really is an issue, again, particularly for first-time buyers who haven't had a chance to build up the equity they need to make a significant down payment on their subsequent home. So that's really what's holding back the market. And that, again, is because home prices went up, and mortgage rates doubled, and wages just haven't been able to catch up quickly enough. The other thing that's been weighing on affordability is that insurance costs and property taxes have gone up dramatically, according to some information from Verisk. And this is a chart from ICE Mortgage Technology that shows you basically what parts of the country people are paying how much at the end of 2024 for homeowners insurance and property taxes. And it tells a pretty significant story there. But according to some data from Verisk, homeowners insurance premiums went up about 9% last year. They went up 12% the year before and 12% the year before that. So what we're seeing right now is a market where it used to be that your insurance and taxes were a very, very minimal part of your monthly mortgage costs. Today, they're anywhere from 20 to 30% of your monthly mortgage costs if you have an escrow account and you're paying your mortgage that way. So it's not insignificant, and it is a concern for borrowers who had to stretch to be able to afford a house in the first place. Imagine you have an FHA loan where you took out a loan with a 3.5% down payment. You thought you just locked into a monthly home payment for the next 30 years, but your insurance rates have doubled or your property taxes have gone up by 30%. And suddenly your monthly escrow payment is $200, $300, $400 a month more. There are going to be a growing number of homeowners who simply can't afford to stay in those homes anymore. So traditionally, we've talked about affordability in terms of what somebody can buy. But with these rising costs in terms of insurance, in terms of property taxes, that affordability is also going to affect people who are currently in the homes, who may need to sell them now because they can't make those monthly payments. So something to keep an eye on as we go forward. So all of these things have become factors on affordability, and it has dramatically slowed down home sales. We've gone from about 6 million sales of existing homes back in 2021 to 5 million in 2022 to 4 million in 2023 and 2024. And it looks very much like we're going to wind up this year right around 4 million existing homes sold as well. So it just is the reality of the current marketplace from an affordability standpoint. We are starting to see some glimmers of good news. Mortgage rates came down to the lowest they've been in over a year. This past week, they were down in the 6.15% range, give or take, for a highly qualified borrower with a 30-year fixed rate loan. And every time you see a mortgage rate come down by 0.1%, it really does have an impact on a fairly significant percentage of prospective buyers who are just waiting for market conditions to improve a little bit. I do not believe we're going to see mortgage rates drop significantly, no matter what the Federal Reserve does in terms of Fed fund rate cuts over the course of the rest of this year. In fact, the last two times the Fed has had a rate cut, we've actually seen mortgage rates go up the following week. So there's not a direct correlation between Fed funds rates and mortgage rates. The mortgage rates are more closely tied into the yield on 10-year U.S. Treasury sales. Those Treasury bond sales have a similar long-term horizon that mortgage rates do, and they tend to move in lockstep. So as you watch those yields, you can kind of gauge whether mortgage rates are going to go up or down. I don't suspect we'll see them get much below 6% by the end of this year and well into 2026. But even at 6%, coming down from 7.25% in the last year is going to be a huge benefit for borrowers. And in fact, we've seen purchase loan applications up about 20% year over year, according to some recent data from the Mortgage Bankers Association. Now, this is the number of borrowers who are applying for a loan in order to buy a house. This is exclusive of refi applications. So keep that in mind. Those are up pretty significantly year over year as well. And there is a seeming disconnect. If we're getting 20% more people applying for loans, why aren't we seeing 20% more sales? And the MBA economics team tells me that their theory is that while we have more people applying for loans, we're also seeing more people being declined for a variety of different reasons. And we're also seeing an unusually high number of cancellations once somebody's actually made an offer on a home. And so there's a lot of churn, a lot of static with these numbers going on in the market. But when we see rates come down a little bit, we do see more prospective buyers jump back into the pool. And I think that's a good sign as we move forward. The other thing that's good for prospective buyers, probably a little less good for sellers, is that home price growth is slowing dramatically. So these two charts are kind of eye tests. I apologize for that. But if you look at the chart on the left, it's a variety of what the change is annually in national home prices. And it's six different indices that look at this: Zillow, Case-Shiller, Freddie Mac, the FHFA, Cotality, and ICE mortgage technology. And they range from a low of Zillow, only seeing home prices up by 0.2%, to the highest one being the FHFA index. And that's the one that really looks at only loans underwritten by Fannie and Freddie, and that's up about 2.6%. You'll notice that all of those are going up less than the rate of inflation. And so what that means is, in real dollars, adjusted dollars, home prices are actually lower this year than they were a year ago, because those price increases are actually going up at a lower rate than inflation. We'll talk about this in a minute, but this is also national numbers. And you're seeing wide divergence in home price appreciation on a market to market basis. We'll touch on that in just a minute, but hold that thought. The other thing we're seeing is an unusually high number of price reductions on properties listed for sale. What most people don't realize is that in any given year, usually somewhere around 33% of homes do take a price reduction once they're listed for sale. That's not at all unusual. What's been unusual is how high the numbers have been this year. Most recent numbers from Altos Research came in at about 41.5% of loans having a price reduction once they were listed. And the numbers were actually much higher over the summer months than they usually are. That's usually a time, spring and summer, when the number of list price reductions declines. That wasn't the case this year. So sellers are getting a dose of reality once their properties are on the market. What I will also tell you is that, based on the available data that I have, these reductions, while they are widespread, aren't particularly big. I just took a look at the most recent data from California, from the California Association of Realtors. In California, the price reductions are about the same. They're at 4.2 or 42% of all listings. But the median amount of that reduction is only 4.9%. So we're not talking about $1 million home taking $100,000 or $200,000 price hit. They're taking less than a 5% price hit, and that's pretty typical of seeing what we're seeing across the country. But again, wage growth coming up at 4.5% a year. Property values not going up that quickly. List price reductions on properties that are listed. All of this, along with mortgage rates coming down a little bit, good news for those prospective homeowners. Inventory continues to go up, and this is one of the reasons why we're seeing those price appreciation numbers as slow as they are. But every state in the country, with the exception of Alaska, saw the number of properties listed for sale up between August 24 and August 25, and Alaska was only off by about 1%. And you see some pretty significant increases: Nevada up by 38%, California up by 31%, North Carolina 36%. So a lot of inventory going up. Now, this is not all because of new listings. New listings are only up about 5% year over year, but it's taking longer for properties to sell once they're listed. So they stay in inventory longer. So the fact that they're staying in inventory longer, in addition to new listings coming onto the market, is why we're seeing these numbers come up. And if you look at the chart on the map on the right here, you can also see that we're starting to actually get to a point where we have more homes for sale, higher level of inventory than we had prior to the pandemic in about a dozen states. Some states like Texas and Florida, a pretty significant increase: 32% in Texas, 25% in Florida, 33% in Tennessee. But we are starting to see a lot of properties on market compared to where we were prior to the pandemic, which is a sign that we're getting back to normal. You can also see that there are huge parts of the Midwest and Northeast where we're still significantly lower than we were prior to the pandemic. And not surprisingly, there's a very strong correlation between inventory and home price trends. So just to start with the map on the right, everywhere you see a blue dot, prices are going up year over year. Everywhere you see a red dot, prices are going down year over year. If you were to compare this map to the one I just showed you, you would see that almost all those areas with blue dots are areas where we still don't have as much inventory as we had back in 2019. Almost everywhere with red dots, and that's what's represented the chart on the left, where you see the metro areas where prices are going down year over year. Again, inventory up, home price appreciation down, anywhere from zero to negative numbers. And you're seeing some markets that were really high flying markets coming out of COVID, markets like Austin, markets like Boise, Las Vegas, Phoenix, parts of Florida, where we saw just extraordinarily quick home price appreciation, are kind of reverting back. And in a lot of cases, that isn't really a sign of economic instability. It's a sign that the markets just overshot their value and are kind of being clawed back to reality by today's buyers. So really, really important as you're looking at properties, as you have borrowers trying to get loans to buy properties, to understand what's going on in local markets. And again, you could be looking at a market in Ohio or Connecticut where prices are going up 8% a year. Very, very different scenario than if you're in the Gulf Coast part of Florida where property values might be going down 8 or 10% a year. So something to keep in mind. I do not believe, by the way, that we are in store for a precipitous drop in home values across the country. As soon as those mortgage rates went up and affordability became more of a challenge, you started to see all sorts of people on YouTube breathlessly warning you that there was going to be a coming home price crash and we're going to see 2008 all over again. Home prices down 40, 50%. That's not going to happen. The likelihood of that happening is just about zero. And the reason for that is that people back in '08 had to sell their homes and they had to get out of those homes and sell them for what they could get. They sold into a market that was oversupplied. We had a 13-month supply of homes available for sale at the time, twice as much as we can usually handle. And there were a whole bunch of people going into foreclosure, which means you were selling into a market that was just full of distressed properties. None of those dynamics are in place today. And in fact, one of the reasons why inventory is still lower than it was prior to the pandemic is people are willing to sit where they are, stay in place with their 2.5, 3.5% mortgages, and wait for market conditions to improve rather than taking a 20 or 30 or 40 or $50,000 haircut. So until those dynamics change, very, very unlikely that we're going to see a crash in home prices. Pending sales, which is something that the National Association of Realtors puts out every month, and it looks at contracts signed, but the deal hasn't fully transacted and been recorded yet. So it's kind of a good indicator of what's to come. We had 3 consecutive months where that index was in negative territory, and in August it reversed course and was actually up about 4% month over month and year over year, and it was up in 3 of the 4 regions across the country, the Midwest, the West, and the South. It was down a little bit in the Northeast. And again, remember the Northeast is where you have the least inventory and the most price increases. So probably not a huge surprise there. What's important to note here, though, is that an index showing a healthy housing market in terms of sales would be at 100. And there's nowhere in the country right now where that is true. The South comes the closest at 88.9, almost 90. But the country overall is just below 75, which again is not showing as healthy a housing market as we'd like. I believe that the August sales, pending sales numbers, because we saw mortgage rates start to come down in August, are going to translate into September sales being stronger than they were in August and stronger than they were a year ago in September. That would mark 3 or 4 consecutive months where we sold more homes than we did a year ago, which is a good sign in terms of the market beginning to more fully recover. And now, for some reason, I seem to have lost control of the slides. Isn't that interesting? Can one of you try and get me control back of these? There we go. So existing home sales were in August, most recent month, and timing of the webinar is a little rough because I believe the NAR numbers are due out later today or tomorrow for September. But The sales in August were down from July, but up on a year-over-year basis. And you can see the chart on the right. We're looking at numbers that are on an annualized basis coming in right around 4 million sales. Um, the other alternative to home prices crashing the way they were predicted to crash, we've seen something like this in the 80s, by the way, is a market that's kind of flat and lackluster for a few years. And when we saw mortgage rates double after home prices had gone up, my theory was that we were going to enter into a reset period of probably 3 to 5 years, where the market kind of reorganized itself around these higher prices and higher mortgage rates. And it really feels to me right now like we're in year three of that 5 year reset. So 2026 early forecast right now for me is it's going to look a whole lot like 2025 and 2024, but we'll start to get marginally better in terms of sales volume. And home prices will continue to be kind of flat, maybe going up just a smidge year over year. And we'll really start to finally feel the recovery in 2026. But it just takes time for the market to reset at these higher price points. New home sales have been actually the bright spot of the industry. The August numbers were off the charts. I don't believe them, by the way, just full disclosure here. These numbers should probably come with an asterisk. We went from an annualized number of 650,000 new homes sold in July to 800,000 in August. You just don't see that kind of swing. And new home sales numbers are notorious for having wild revisions in subsequent months. So I would expect when the revision to the August numbers come out, it's going to be lower, but it's probably still going to be much better than what we saw in July. We're going to wind up in a normal year, new home sales probably only account for 10 to 12% of all home sales. So given that we're going to be selling about 4 million existing homes, you would normally see new home sales coming in somewhere between 4 and 500,000. They are almost certainly going to come in above 650,000 for the year, so a much higher percentage. Prices actually went up a little bit in August as well, and we're seeing builders making a lot of concessions. They're offering price concessions. They're offering upgrades to properties. They have started to build smaller homes in order to be able to price them more attractively, given the higher cost of financing. And they're also offering kind of preferred financing. They're coming in and buying down points on mortgages, which makes it difficult for existing home sellers to compete. But not unusual to see a builder offering mortgages of 4.95% in a market where the normal number is closer to 6.25. So in many cases, in many markets, it's actually a better deal for a buyer to be buying these new homes than it is an existing home. There are quite a few of these new homes that are under construction or where ground has just been broken. And there's an unusually high inventory of those properties. We probably all in have about an 8 month supply of new homes. Only about a quarter of those are completed construction. The other three-quarters, as I said, are under construction or the ground's just been broken. And in order to work through that backlog, the builders have slowed down in terms of both permits and housing starts. So we're not seeing we'd like to be seeing housing starts running at about 1.5 million because we do still have a deficit in the number of homes in the market compared to what ultimately the demand will look like. And I'll show you that in a second. Um, but I do think it's the builders just being circumspect, being very careful not to overbuild in a market where demand isn't as strong as they'd like it to be because of affordability. We did see an annualized rate of about 1.6 million homes completed. And we need to stay up there again just to kind of make sure we get the supply to where it needs to be. But a lot of inventory of these homes for sale. The inventory of existing homes for sale is about 4.5 months. Once we get a little higher than that, maybe up to a 5 month supply, it starts to feel more like a buyer's market than a seller's market. We've been in a very strong seller's market now for a number of years. And the inventory number on new homes is usually a little higher. And so that 8 months is kind of within the normal realm of what makes sense from a new home supply standpoint. The reason I said there will be more demand coming is because America's getting older. We had almost 4.8 million young adults reached the age of 35 last year. That's the highest number we've seen in at least the last 50 years. And the reason that number is significant is because that's typically an age where young adults have formed households and are looking to buy a house. And the research, despite what you read in the press, if you ever have a doubt, just reach out to me and I'll tell you what to believe and what not to believe, based on my, of course, omniscience and wisdom. This is just my opinion, folks. Um, is the research all says that millennials, that's who this group is, really do aspire to home ownership at the same levels as prior generations. They're just getting into the market later. If you remember when they started coming of age, they were getting out of college during the Great Recession. There were no jobs available. It took them longer to get that first real job that they wanted out of college. Meanwhile, they were paying down an enormous amount of student loan debt. So they got that first job later, they got married later, they're having kids later, they're buying their first home later. But they are reaching that number at increasingly high levels, and we'll see more hit 35 this year and next year. And so it really is a lot of pent up demand, which again is why I think when we see mortgage rates come down, a lot of these people are jumping into the market looking to try and get a loan. And for the younger adults, the ones 25 to 34, we're seeing fewer and fewer of them living at home with mom and dad. So apparently, parents are taking the Xbox, putting it out in the driveway, changing the locks. When Junior comes home, it's time to rent that first apartment. But that is the other thing to consider is that as these young households are forming, more of them are becoming renters simply because they can't afford to buy a home in today's very, very affordability challenged market. And you can see this data from John Burns' research on the left that shows you how many more renter households there were. And because of that delayed home ownership we were talking about, almost three-quarters of the US renter population is 30 years old or older, which is the highest it's ever been. And for those of you who are doing DSCR loans, by the way, this presents an opportunity. These are folks who typically would be buying a house by now. Stands to reason if they have a family, maybe they'd prefer to rent a house than to rent an apartment. And so I do think there's going to continue to be opportunities for single family rentals as we go forward, and you're dealing with investors who are looking for that kind of inventory. So keep that in mind. Until affordability gets better, we have more and more of these young adults, literally millions of these young adults, coming of age and looking for a place to live, and they'll rent if they can't find something they can buy in a neighborhood they'd like. The other thing to point out is the number of homeowner households actually went down for the first time in a number of years. For the first time in the last quarter, I suspect that'll be a short-term dip, but it is something to keep an eye on. Again, kind of pointing toward rental opportunities. But the other thing I wanted to point out from a demographic standpoint is the nature of the home buyer. If you look at household formation today, and if you look at home ownership growth, the clear message coming out of all of the data is that in the next 10 years, the very likely prospect is that minority buyers will be the majority of home buyers. Most of the home ownership growth is coming from the Hispanic community, from the Asian American community, from the Black community, as we move forward. And while white homeowners still have the highest home ownership rates of those groups, we're seeing most of the population growth in minority communities. So as you're thinking ahead, remember that people like to do business with people like them. So as you're staffing up, be thinking about what this community looks like going forward and how you're going to best serve that community, both in terms of language skills, in terms of hiring, and staffing and the like. So keep that in mind as you're going forward. Americans, young adults coming of age, and that future generation of home buyers being the most diverse in the history of the country and also being the most tech savvy. So keep that in mind from a technology standpoint as well. The other market to pay attention to is the investor market. I know that A&D offers DSCR loans and other non-QM products, and some research I've done with a company called Batch Data shows that investors own 20% of all single family homes nationwide. huge percentage of single family detached properties. And it ranges from 30%, over 30% in states like Maine and Montana, uh, high 20% range in states like Alaska and Hawaii. These are all states where tourism plays an important role in their state's economy. So a lot of these properties are short-term rental properties, not your typical, annual lease kind of properties. And then there are some states like Connecticut, for example, like Minnesota, where you're dealing with more like 10%. But even those states, 10% of all properties owned are owned by investors. And so that's something to keep in mind as you're going forward. If you're not dealing with investors, you're not dealing with 20% of the homes that are owned across the country. And you missed out on a third of sales in the second quarter of 2025, when 33% of all single family homes that were sold to investors. And who are these investors? Is it Blackstone and BlackRock and American Homes for Rent? All these huge institutions that are gobbling up Main Street across the country and making it impossible for poor home buyers to find something to buy? Nope. These investors are mom and pop. These are people that own 1 to 5 properties, and they make up 87% of all investor-owned properties across the country. If you add in investors who own 10 or fewer homes, you get to 91%. And in fact, those huge institutions that own 1,000 or more homes only account for 2% of the investor-owned properties across the country. These are the people you're targeting, and these are the people who typically do need financing help. And these are also the people who typically, about 79% of the time, are buying a property in or near their home, their home county, home metro area, almost always within their own state. So these are the local investors that you're looking at who really comprise the overwhelming majority of the marketplace. What's going on in terms of delinquencies and defaults? And we'll wrap up with this. Consumer debt in the second quarter, and I'm waiting for the third quarter numbers to come out. This should be fascinating. But consumer debt rose to a record of $18.4 trillion in the last quarter. Now, about 70% of that is mortgage debt. And so that's offset by about $35 trillion of homeowner equity. So economists aren't too worried about that debt, but we're still dealing with almost record level of debt in the credit card market, about $1.2 trillion there at a time when credit card interest rates are routinely at 25 or 30%. Near record levels of debt in auto loans, near record levels of debt in student loans, which is becoming a real problem, as we'll see in a minute. Uh, Delinquencies on all of those loans has gone up now for the ninth time in the last 10 quarters, since bottoming out as we came out of the pandemic. And remember that all the government stimulus that came into the market, people were getting government checks, and in a lot of cases paid down that debt. So the delinquency numbers became unusually low coming out of the pandemic, but have been recovering at a pretty rapid rate over the last few quarters. And this again has to do with cost of living and people having a hard time making ends meet because of that inflation we suffered a couple of years ago and really haven't been able to recover from yet. So delinquency rates aren't quite as high as they were prior to the pandemic, but they're very close. And I would suspect when the third quarter numbers come out, we're either going to be at those levels or a little bit higher. And the more probably problematic statistic is serious delinquencies. So 90 plus days delinquencies by type of loan. Just about the only category that's not back to pre-pandemic levels is mortgages, interestingly enough. We'll talk more about mortgage delinquencies in a minute. But you can see that auto loan delinquencies are up where they were prior to the pandemic in the serious delinquent category. Credit card serious delinquencies way higher. And look at that big red U there for student loans. So for a number of years, student loan payments were not required. And even once they were required, they weren't reported as being delinquent. That all changed in January this year. And since January, look at the spike in student loan serious delinquencies. If you look at overall delinquency numbers, student loans are actually up at a higher level than they were prior to the pandemic. But the seriously delinquent numbers are going up pretty dramatically. One of the things to keep in mind if you're a lender is that if a student loan goes 270 days delinquent, if it's a government-backed loan, the government can start garnishing wages. Day 270 hit this month for a lot of these borrowers. So they could suddenly start to see if an average loan payment is $500 to $600, they could suddenly start to see their wages being garnished, which might make it more difficult for them to pay their mortgage. So these student loans are something to keep in mind as we're moving through the end of the year. Mortgage delinquencies, the most recent data I have is from July. Um, Sorry, yeah, it's from August from ICE Mortgage Technology, and mortgage delinquency rates were at 3.43%. Their average for from 2020 to 2025 was about 4.27%, and the historic low is about 3%. So we're way off normal numbers and almost at record lows, but they are up month over month and they're up year over year just a little bit. Um, Mortgage delinquencies have a tendency to track very closely with unemployment. You remember I showed you unemployment rates were running around 4%, and delinquency rates are running a little bit below that. But again, uh, the fewer mortgage delinquencies you have, the fewer foreclosures you're going to see, and that's the real reason why foreclosure activity's been as low as it's been over the last couple of years. If you're in a market with a lot of FHA loans or a lot of VA loans, you might be seeing a slightly different story. FHA loan delinquencies now are up to about 12%. VA loans are running around 6% delinquency rates. So those borrowers are having a harder time making their payments. The conventional 30-year fixed rate loans from Fannie and Freddie, and even from lenders who keep the loans on their portfolio, jumbo loans, for example, they're running their performance is at the best it's ever been, record levels of strong loan performance. So great credit quality, well qualified borrowers making all of their payments. So what you are seeing in distressed activity is primarily driven by FHA borrowers and VA borrowers who are having a hard time making their loan payments. And those are contributing to seriously delinquent loans in the mortgage space. So mortgage delinquency rates have kind of flattened and they're not very high. But once those loans are into delinquency, the borrower is having a harder time getting out of delinquency. So we are seeing more seriously delinquent loans in the mortgage space, and we will probably see more of those delinquent loans roll into foreclosure because the FHA has tightened up its loan modification and loss mitigation waterfall. And what was happening is an FHA borrower would get seriously delinquent. They'd work with their servicer. The servicer would let them execute something called a partial claim, which means they got to take some of their equity, use it to get back to current status, and what they just took out of their equity now becomes a second loan that's not payable until the loan is done. And some borrowers did that three, four, and five times to kind of go from delinquent to current status. FHA tightened those rules up now. You can only do that once every 2 years. So a lot of those borrowers who were using that loophole to get back to current status don't have that loophole anymore. And I suspect we'll see more of them roll into foreclosures. If you look at all foreclosure activity, foreclosure starts, foreclosure sales, and bank repossessions, that activity was up about 1% from last quarter, about 17% from a year ago. But keep in mind that foreclosure activity dropped by about 10% in 2024. So we're coming up again off fairly low levels, but you can see we're nowhere near where we were back during the Great Recession. We're really only running at about 70%, 60% of where we were prior to the pandemic. So very low levels of foreclosure activity. Foreclosure starts were down in August, month over month, but up about 6% year over year. And there were about 23,000 more loans in foreclosure in the month of August than there were the prior year. So we are starting to see a gradual return to pre-pandemic levels, but it's not coming back evenly. It's a very uneven progression, and it's still not where it was back in 2019. And by the way, 2019 was not a big year for foreclosures either. Some data from auction.com tracking the number of foreclosure auctions actually taking place across the country. And this is not just auction.com auctions, it's all auctions taking place. And you can see in most of the country, numbers are actually up on a year over year basis. But in some parts of the country, Florida, New York, Illinois, a lot of states that do judicial foreclosure processes, the numbers are still down on a year over year basis. And overall, we're still running about 45% lower than we were prior to the pandemic. So if you have investors or home buyers looking to buy foreclosure properties, first thing to tell them is that there's not as many auctions happening as there were prior to the pandemic. So a good place for them to be looking is at homeowners in the early stage of foreclosure who need to sell to get out from under a loan they can't afford anymore. And in fact, about 55% of all distressed property sales right now are in that pre-foreclosure period, somebody buying the home directly from the homeowner, and obviously making up whatever past due amounts are due to the lender. We're also starting to see a little bit of short sale activity where you're buying a property for less than the amount due on the mortgage, and the lender is forgiving that debt in markets where property values have gone down, like parts of Florida. So some changes in the market. And then in terms of bank repossessions, lender repossessions, which are called REOs, according to Adam, again, that activity is up about 4% quarter over quarter and up about 33% year over year. But if you look at the chart and you're looking to try and see that 33% increase, you can see basically it's a flat line. So we're so far off normal levels of REO activity, of repossession activity, that even that 33% lift didn't make much of a dent. So last place to look for foreclosure property is repossessions by the lenders. There's a little of that going on, but not a lot. Um, if you're going to those foreclosure auctions, make sure you know what you're doing before you start bidding on those properties. But we are seeing more of those properties coming to market at the auctions. And then again, probably the best place to look is early stage of foreclosure. So just to kind of recap what we talked about here, the economy is outperforming expectations, but keep an eye on the weak jobs market and that record level of consumer debt. Affordability really is the biggest constraint in the housing market right now. Rising insurance premiums and property taxes are adding to the problem, but lower mortgage rates are helping, and increased inventory is causing home price appreciation to flatten out and even go negative in some markets. So all of that combined with wage growth should help from an affordability standpoint over time. We do have strong demographic trends that should provide for opportunities for both owner-occupied home sales and rental markets in the months ahead. And keep in mind that next generation of home buyers is going to look a whole lot different than the last generation of home buyers did. Foreclosure activity overall still running at least 30% below pre-COVID levels, but we're starting to see the numbers gradually work their way back up. We talked about people not being able to afford making payments anymore on their homes because of insurance premiums and property taxes. We're already seeing higher delinquency rates, by the way, among those people and among people with student loan debt. They tend to be delinquent more often than people without student loan debt. So we could see a little bit of an uptick in foreclosure activity because of these market conditions. And then again, if you're not working with investors right now, and there's kind of no excuse to not work with investors if you're dealing with non-QM loans, you're missing out on a third of the market today, which is just crazy. That's the highest number I've seen in at least 6 years, by the way. But normally, you're still looking at between 20 and 25% of buyers. So it's crazy not to be paying attention to that market. So appreciate, again, the opportunity to share all of this with you. I hope I didn't overwhelm anybody too much. Would like to see if I can't turn this back over to Jerry and ADM. I think I just jumped ahead for you there, but maybe our ADM marketing team can take that back over on your end, Jerry, and you can wrap up.
Absolutely. Thanks a lot, Rick. That is absolutely amazing info. Lots to absorb there, no doubt, but I really felt like he explained a lot of it really well as far as why things are happening, not just what happened, but why it's happening and what potential impact it has, especially for our partners. I want to open this up for questions. I had not seen any in the QA box yet, but if any of you have any questions while we have Rick here, it's a great opportunity for you to just fire away. Throw those up in the box, and we'll give you an opportunity to get those answered while we have Rick. One thing I wanted to discuss with everybody before you leave, one of the things that we've really wanted to stress to our partners and to our potential partners is that our non-warrantable condos programs that we have. We really have a lot of programs designed specifically to help people who are looking to acquire non-warrantable condos, and this is it's a great opportunity for investors and even for new home buyers that aren't looking for single-family homes. So um, please take a look at that. Go to our website, subscribe to our emails. One of the great things about our email system is you just scan here and you get to choose what types of emails you receive. We're not just going to spam you across the board, and you can choose which types, whether you want rate sheets, if you just want new programs, or you're looking for news. You really have a way to customize that, and it's a fantastic system that we've developed for our emails. So I encourage you to do it because you're going to get information that matters to you. So as far as other things that we have coming up, I talked about the AD Vantage loyalty program earlier. Really proud of this program here at AD. We have a webinar coming up where we talk all about it on October 30th, 1 p.m. Eastern. And then we have our business partner orientation webinar, which is excellent if you're a new partner with AD. We go through a lot of different things with you and get you settled. So we encourage you to become a partner if you're not already. Scan the QR code, talk to one of our AEs, and we'll get you started working with us on finding solutions for you. Just a reminder, because I forgot to mention at the beginning, I did put it in the chat, but we will be sending you a copy of the PowerPoint and a copy of the recording of this entire webinar. You'll receive it sometime in the next 2 to 3 days. But we really appreciate you all coming. Thanks again, Rick, for all, I mean, just amazing information and a great analysis of that information. So thanks again, everyone. Hope you all have a fantastic day, and we hope to see you again soon.